I've been getting a lot of member requests and subscriber requests to do a video about Iron. This is a company that's turning from a Bitcoin mining company to an AI cloud services provider. It recently signed a massive deal with Microsoft that put the company on the map. And so in this video, I'll talk about the latest developments at Byron and let you know if I think this stock is a buy old or sell at current market prices. So the biggest reason why I would be interested in Iron stock right now is because of that massive deal with Microsoft. So let me go over the terms of that arrangement. They signed a $9.7 billion value deal with Microsoft for a 5-year term. What's beneficial for Iron is they received the 20% prepayment. That's huge for a company like Iron, where capital costs are a big deal. And this deal allows the company to invest in the product and materials they need to build the supply capacity to serve this agreement with Microsoft. 20% prepayment is nearly $2 billion, a massive sum to be sure. The ending annual revenue contribution from this arrangement is roughly $1,940 million. And I believe that's just taking the 9.7 billion and dividing it by 5. So it's an equal term deal. It seems like with the same amount for each year for the next 5 years. And if you compare that, the company generated just 240 million in revenue in the most recent quarter. So annualized, they're barely at $1 billion in annual revenue. So this deal with Microsoft would more than double more than triple, almost triple their current annualized revenue run rate. So understandably, this caused a huge surge in my in-stock price as investors became more interested in the company following this arrangement. So they expect to have 140,000 new GPUs by the end of 2026, and they're targeting the total $3.4 billion annual recurring revenue by the end of 2026. Again, that's a big improvement from the current revenue of 240 million, by the way, which was up over 300% year over year. So they are growing rapidly, as are other providers of this kind of power, including CoreWeave and Nebius Group. There's strong demand everywhere you look for the computing power required for artificial intelligence. Businesses like Microsoft, Amazon, Alphabet, Meta Platforms are spending over hundreds of billions of dollars to develop these technologies. And they want to develop these technologies in a distributed fashion in a way that's not all on their own balance sheet. That's why they're partnering with companies like Iron to develop some of the technology that they can rent out and not own. They don't want to own all of the technology. They want to do a mix. They want to own some of it. They want to rent some of it. Just in case, let's say you look ahead 5 years from now and demand for artificial intelligence is not growing as much as it's growing now, or maybe there's a big change, then companies like Microsoft won't have all of that extra capacity that they may not need 5 years from now. And so they can keep all of the capacity they have internally, and then the ones that they're renting out, let's say from Iron, let's say at the end of the 5-year term, Microsoft doesn't feel like it needs this computing power anymore. They won't renew the contract with Iron. But if demand looks strong and they indeed need this service, then before the contract is even finished, they'll negotiate with Iron and extend this contract further. So it gives the company flexibility. It gives them optionality. If things are going well, then Microsoft can renew these kinds of deals. If things are not going well, then Microsoft can, when these contracts end, they can just say, okay, thank you for your service. We no longer want these computing power that you're providing us. Now, interestingly, in its most recent quarter, Iron generated 385 million in net income when it only generated 240 million in revenue. These are rare cases where a company generates more net profit than in the revenue they generate. And when these happen, it's usually as a result of some financial assets that they hold on the balance sheet and they need to market every quarter. So let's say you have on your balance sheet an equity investment in a company that's worth $1 billion. And then during the quarter, that company's valuation grows to $10 billion. So you just experienced a $9 billion gain on an equity investment in something that you own. That could lead to generating profit during the quarter that's much larger than your revenue during the quarter, because that gain in investment value just goes into your income statement as profit. There is no revenue associated with it. That's just profit. And so that creates this big increase in your profit without any increase in your revenue. And so you have these kinds of situations where net income is much larger than profit, which is what happened with Iron. They had some prepaid forwards and capped calls, some options contracts. These are financial instruments that they needed to value at the market, right? So every 3 months, the values of these assets change. And Iron needs to account for that change on the income statement. And in the most recently completed quarter, these assets happened to increase in value. And so that created this increase in profitability for iron. It wasn't to do with their operations. It was a change in financial asset, which is a less preferred way for a company to increase its profitability. Just wanted to go over their financials a little more thoroughly here. The company's revenue increased by 28% from the previous quarter to 240 million, but year over year, that was a much larger increase. Bitcoin mining revenue increased from 180 million to 233 million. So you can see here the bulk of its revenue right now, 233 million out of the 240 million came from Bitcoin mining. So it's still very much a Bitcoin mining revenue concentration right now, but by the end of next year, it's going to flip and it's going to be very much AI cloud revenue that's overtaking the Bitcoin mining revenue. So the company benefited from a 16% increase in the average price realized per Bitcoin from 99,000 to 114,000. Of course, Bitcoin prices are back down closer to around 100,000 during the current quarter, and AI cloud services revenue increased from 7 to 7.3 million, which was not a big increase, but once they start serving this Microsoft arrangement, remember 2 billion in annualized revenue run rate from this Microsoft deal. So that's going to overtake Bitcoin mining revenue as the primary revenue generating source for the business, which is something I would rather have than Bitcoin mining revenue. Bitcoin, I'm not as bullish as on Bitcoin as everyone else is. I think it's one of those assets that you can only make money on by selling it to somebody else. And I don't like those kinds of assets similar to gold or any other commodity. I don't like when the only way I can make money is by buying something at a lower price and then selling it to somebody else at a higher price. I like when I can buy an asset like a stock, a business, maybe real estate, where I never need to sell that asset and the asset itself generates cash flow. A business generates cash flow through its operations, creating a product and selling a product and making a profit. I never need to sell that business to anyone else. I can just hold that business forever. That business will generate profitability and I will own a percentage of those profits. Real estate, similar. I can own real estate, a rental property, and never have to sell it. I can just rent it out and generate cash flow from the rent that the household generates. But with Bitcoin or gold, the only way I can make money is by selling it to somebody else. And I don't like that kind of dependence of, oh, in the future, I'll be able to find somebody else to sell it at a higher price. So that's the primary reason why I don't like cryptocurrencies or gold or any of those kinds of assets. So here's more detail on that unrealized gain. They talk about it here. They say it's an unrealized gain on financial instruments of $665 million. So without that, the company would have generated an operating loss of 76.4 million, and their operations turned to a loss from the previous quarter where they generated 21 million in operating income. So this stock is trading at a forward price to earnings of 195, which looks extremely expensive. But if you look at it on a forward price to operating cash flow at 7.883, it looks really cheap. Overall, if you look at the last month, the stock price is down 22%, and it boasts a market cap of 14 billion. I think at a market cap of 14 billion with the contract from Microsoft, I think it's the beginning. I think you're going to see iron sign deals with other large cloud service providers. I think the deal with Microsoft gives the company credibility to go and sign deals with other companies, and I like the terms of the arrangement with Microsoft. I like that they got that 20% prepayment. So overall, to answer the question, what do I think about iron? Is it a buy, hold, or sell? I think the stock is a buy, but it should only be considered for very high risk tolerant investors. This is in the category of the highest risk possible. So high reward potential to be sure, but it comes with extremely high risk. I've been getting a lot of member requests and subscriber requests to do a video about iron. This is a company that's turning from a Bitcoin mining company to an AI cloud services provider. It recently signed a massive deal with Microsoft that put the company on the map. And so in this video, I'll talk about the latest developments at Byron and let you know if I think this stock is a buy, hold, or sell at current market prices.